Financial evaluation, very important topic in financial management. Now, the approach that I'm taking is to teach those that are doing graduate finance, undergraduate, those in high school that want to do financial management or aspire to go into finance, for financial managers, those that are trying to understand or just do a refresher on financial management. So the topic that I'm introducing obviously is financial analysis. It's very important, and I'm going to teach a number of sessions on a financial evaluation. And the very first one that I will look at will be financial statements. And then thereafter, I'll look at the other sessions. I'll look at all of the other areas that we look at in financial evaluation. But as a starting point, I wanted to define what is financial evaluation. Well, financial evaluation, as a simple definition, it is the standardization of financial data that allows us to see the weaknesses and strengths of an organization. So if we calculate financial ratios and percentages that give us a picture that just the financial statements will not give us. Now, who uses financial evaluation? I've tried to list here, not exhaustive list of those that will be interested in using financial evaluation. Financial managers, financial investment managers, credit managers, security and investment analysts. The banks will be interested in looking at financial evaluation, or they do financial evaluation before they extend loans to companies. Prospective employees, and particularly here we're talking about top management. When, say, CEO is going to take over a company, they'll always try to understand the financial performance or financial strength of the company they're taking over. Financial auditors. For financial auditors to assess the financial performance of a company, they will do some financial evaluation as well. And lastly, I added the unions. Now, somebody's going to ask a question, why would unions want to know about financial strength of a company? Well, the unions who look at the financial strength of a company, financial evaluation, to use that as the basis for them to negotiate for their members. So unions that have good leadership, they look at the financial performance of a company before they go out there and negotiate for benefits for their members. Now, in financial evaluation, I'm going to cover 8 topics, so I'll go through 8 sessions. And the very first one that I added was to look at financial statements. And the reason is simple. For you to do financial evaluation, you have to have financial statements. And I thought it's very important that you have an understanding of financial statements. And thereafter, we'll go into liquidity. So after this, keep looking out for the next session. We'll do liquidity. A short session on liquidity, and then we'll do asset management ratios, we'll do financial leverage ratios, we'll do profitability ratios, we'll do the market-based ratios, and we'll do dividend policy ratios, and then common size financial statements. Now, every one of these ratios, or every one of these areas that allow us to analyze a business, will focus on a certain part of an organization, a certain part of the financial performance of the business, and will give us a sense of how the company is doing in that area. For example, the liquidity is going to be looking at the short-term capability of a company to meet short-term financial obligations. So we'll be comparing the current assets and current liabilities. In asset management, we'll look at how well the company is using its assets to generate its revenues. And then on the leverage ratios, we'll analyze to see how highly indebted a company is, or how heavily a company is relying on borrowed funds. Profitability ratios, we'll look at how profitable the company is. And then there are a number of ratios that we'll look at there. Then we'll jump into market-based ratios. In here, we'll look at, for example, we'll look at the market price or the stock price of a company compared to how much the company is paying in terms of the earnings the earnings per share. And then we'll look at the dividend policy. We'll look at, well, when the company pays dividends, right? How much are they paying in dividends compared to what the company has earned, right? And then lastly, we do the common size financial statement, which is basically calculating everything on a financial statement as percentages, okay? So, as a starting point, obviously, what are financial statements? Well, financial statements are reports. The report that a company is required by the generally accepted accounting principles to reveal the financial performance of a company. So, by GAAP requirement, a company is responsible for providing those reports that will show the cash flow position of a company, that will show how the company is generating its profits and the overall financial condition. Now, what are those financial statements that we'll be looking at? There are basically three important financial statements that you are required if you're a company or you're an organization that you're required to provide. And those are, we have the income statement, also known as the profit and loss. And we have the balance sheets. The balance sheet reveals what we call the assets and liabilities of a company at a point in time. And then when we go to see how a balance sheet looks like, I will re-emphasize that. And then cash flow statements. The cash flow statement reveals the cash inflow and cash outflow of a company. So here's the three financial statements of a company. An income statement. It shows our financial performance over a given period of time, over 1 month, over a quarter, or over a year, okay? And it captures the revenue or the sales of an organization and all the expenses, and then it reveals how much is left on the table for the investor or for the shareholder or for the owner of the company. So the profit and loss or income statement captures all your revenue, and then it also captures all your expenses, and then gives us the difference between those two buckets of your financial data. So it will reveal our profit, it will also reveal our loss if our expenses were higher than our revenue. And then our balance sheets. The balance sheet reflects the financial position of a company at a point in time. It's like a snapshot, it's like a picture, right? And this happens at the end of the month. You can do your balance sheet. At the end of the quarter, you can do a balance sheet, or at the end of the year, you can do the balance sheet. And it shows our total assets. Now, I don't know whether my pointer here is showing, but it shows our total assets, our total liabilities. It also reflects our stockholders' equity. And lastly, our cash flow statement. Our cash flow statement shows the inflow of cash and the outflow of cash in a company. So at the end of the day, it shows you as to whether you were in a negative from the cash flow standpoint or you went positive from the cash flow standpoint. These three financial statements will give management or the shareholders a picture as to whether this company is doing well financially. Here's an example of an income statement. Like I say, your income statement is going to capture all of your revenue, right? And all your expenses. And at the very bottom, it will show your profitability, okay? What we call the earnings after taxes. So let's follow what we have here, the simple income statement that I've put together here. So we have at the very top, net sales. What makes up net sales? In financial management or in financial accounting, when you have the word net, the net basically means you started with a number and then you had to adjust that number to come up with the bottom line or to come up with a number. So when we say net sales, we're saying we had some sales that we had to adjust. Now companies will adjust sales by adjusting by allowances or returns or they'll issue rebates and all that. That will reduce what they end up showing as the sales of a company or the revenue, and therefore they'll call it net revenue. The next line item that you see here is the cost of sales, right? So we had $100 million in our revenue or our sales, and then I'm showing $40 million in the cost of sales. What goes into your cost of sales? As a company, what is reflected in your cost of sales is the cost of producing the product. That is, if you produce, you're a manufacturing company. The General Motors, what goes into producing a Chevy, or what goes into producing the cars, that is what goes into your cost of sales. If you're Walmart, the cost of merchandise that you end up selling in your store, that's what goes into your cost of sales. Now, for a company like Walmart, the cost of even transporting the goods to the Walmart store is also included in the cost of goods sold. The difference between your cost of goods sold and your sales and your cost of goods sold is what we call the gross profit or the gross margin, right? And then after your gross margin, now the company introduces the operating expenses. So you can see your operating expenses here. I've given some examples. What are those examples of your operating expenses? Saying when you have your selling expenses, those are your operating expenses. Your general and administrative expenses, they're operating expenses. The rent, the lease expenses, insurance, the depreciation of all of your fixed assets is also included in your operating expenses. When you subtract your operating expenses from your gross margin, you end up with a number here that we call the earning before interest and taxes. Sometimes this actually is referred to your operating profit. The reason being, it's the profit that you arrive at after you've taken out all of your operating expenses. Then after your earnings, your earnings before interest and taxes, also called operating income, you introduce your interest charges. When you take out your interest charges, you arrive at your earning before taxes. And when you subtract your taxes, you arrive at your earnings after taxes. The earnings after taxes is your number that is available to the shareholders. So if you're going to distribute any of your dividends, they're going to come out of your earnings after taxes. In a nutshell, that's your income statement, also known as your profit and loss statement. Next is your balance sheet. Like I said, your balance sheet gives us a snapshot of the financial position of our company. It gives us our assets, our liabilities, and the stockholders' equity. So let's go through what I've listed here. An example of a simple balance sheet. We have at the very top assets, but within your assets you have two buckets within your assets. You have what we call the current assets. Current assets. What are current assets? The current assets are assets that can be converted into cash within a year. Okay? So cash is a current asset. And if you have marketable securities, they're current assets because you can sell those securities and turn them into cash at any point in time. Accounts receivable is your current asset. Why? Because you can convert your accounts receivable into cash within a year. How? You can sell to your customer. And if you're a cash basis, organization or company, you get paid right away. Okay. Then inventory. Inventory are current asset. You can sell your inventory. It turns into accounts receivable. Or if you sell it right away, it could become cash if you're selling it on cash basis. Okay. So your accounts receivable is what when you sell a product to your customer and they don't pay right away, becomes accounts receivable. Okay. So this is not exhaustive. There are other items that can fall within the current assets, but I gave you just a few examples of what falls in your current assets. The long-term assets. Long-term assets includes all of your fixed assets. And some of the examples of the fixed assets, I have the plant and equipment here. Your buildings. I didn't include, if you have trucks or cars and vehicles, all of those would fall under long-term assets. That's the asset side of your balance sheet. Now we go to the second side of your balance sheet, which is the liabilities and stockholders' equity. Now you can see at the very top what we have is the current liabilities. Current liabilities are the liabilities that an organization is required to pay within 12 months or within a year. And in your current liabilities, you have such items as your accounts payable, all your suppliers for your materials. Okay? They are in your current accounts payable. Bank notes that are payable within a year. Okay? They fall under your current liabilities. Accrued taxes, all those. And other liabilities that you know that are supposed to be paid. Say, for example, your employees at the end of the year, you haven't paid them. You accrue that, and then it becomes a liability. And therefore, it's very, very important that you understand what is under your current liabilities. The next side of your liability and stockholder side is your long-term liabilities. As it says, long-term. Okay? Any liabilities, you get a loan from a bank. It could be debentures from a bank that is a 10-year mortgage. Any long-term liability is under your long-term liability, as I said. If you issue bonds of the company, those become long-term liabilities. Okay? So the combination of your current assets, your current liabilities, as well as your long-term liabilities will give you your total liabilities. And right below that, we have stockholders' equity. What is in stockholders' equity? The stockholders' equity is the money that we say belongs to the stockholder, the shareholders. And I have examples here of what is in my stockholders' equity. You have all your returned earnings from prior periods. If you look at our profit and loss, the way we have our profit and loss, the profit that is coming from our revenue generation, that becomes a shareholder's equity part. And if we don't distribute it, we make it as returned earnings in a company, it becomes part of stockholder's equity. And then whatever the shareholders invested in the company is part of stockholders' equity. Lastly, our cash flow. Very important. Because the reason why a company needs a cash flow is that sometimes there are items that you're going to sell on credit. The fact that you've sold it on credit, you haven't collected the money, but you will still record as revenue. Okay? So sometimes you might be blindfolded, right? Not knowing that you have a cash flow problem. Having a cash flow statement will reveal at the end of the year, or at the end of the quarter, or at the end of the month, whether you had a positive cash flow or negative cash flow. So look at what we have. A cash flow statement has 3 buckets. The cash flow statement has 3 buckets. It has, at the very top, cash flow from operating activities, and then it has cash flow from investing activities, and then it has cash flow as a result of financing activities. Now, if you've done financial management before, you'll realize that by merely calling those, you know what belongs there. Now, I have to give a few examples so you know what is in there. What is under cash flow from operating activities? Cash received from our customers, from our accounts receivable. When you collect that cash, will be reflected under there. When we pay our accounts payables, which is part of our current liabilities, it's going to be reflected there. When we pay our employees, we pay insurance and all those things, all of that stuff, they'll fall under cash flow from operating activities. The second bucket. Now, each one of these will show the net. Now, I explained what net means. It means a lot of other stuff that you've put together, and then you come up with what is left, right? The next bucket, investment from cash flow from investing activities. What are investing activities? When you sell company assets, you are acting on an investing activity. When you purchase company fixed assets, it's an investing activity. The net from all of those is what we're going to show there. So if we purchase a car or we purchase a building, all of those things are going to fall under the net cash flow from investing activities. And lastly, cash flow from financing activities. As the word financing, it means things that are to do with investors. Okay? When you borrow, you've acted on a financing activity. When you issue stocks, you've acted on a financing activity. When you pay dividends, it's a financing activity. So, what are under financing activity? Cash received from lines of credit, the loans, stocks, when we pay off bank loans, when we pay dividends, all of that are financing activities. So, I have outlined the financial statements. The 3 financial statements, very important. And it was important that we looked at them. And the reason being, there's no way you're going to go into financial evaluation without knowing how financial statements are laid out. I hope this has created a very strong foundation for you. So as we go into the next sessions, you're going to understand what we are doing. So before you go, please, you need to comment, you need to like, you need to also subscribe so you can, and share, okay? Thank you very much. This is the material that I teach in the university, so you have your own professor in your financial management classes. Thank you.